I've got a great agenda today. We've got a number of members of our advisor and operation teams that will be sharing with you today. Our agenda today is really being driven by some of the most popular questions that we've been receiving lately from clients, as well as a great new financial planning opportunity for those interested in long-term compounding. So we'll start talking about the new 530A accounts that were actually just launched this month on the 4th of July. We'll talk about performance. We've had fantastic start to the year performance-wise, and we'll talk a little bit about what's driving that performance. Then some of our advisors are going to talk about initial public offerings or IPOs. It's a hot topic with the SpaceX IPO and a couple of more big ones to come here in the next 6 to 12 months. So we've got some great data and research on that we'd like to share with you. And then finally, we'll end up with just a little update on the firm and some of the happenings that are going on here at Aspen Capital Management. Before we jump in, just a quick disclosure, a reminder, we'll be discussing past performance today. And so we want to make sure that everyone remembers that past performance is no guarantee of future results. Taj, before we get started, I just want to say I love these new 530A accounts as a multi-generational planning tool. So whether you're a parent or a grandparent attending today, you're going to want to make sure to pay close attention to the 530A accounts as a fantastic opportunity long-term for compounding for your family.
Perfect. Thank you, Mike. Today, I'm joined by two other members of the Financial Planning Committee, Scott Warner and Johan Simpson. We'll be discussing the ins and outs, like Mike said, of the new Section 530A, also known as the Trump accounts. Everyone here may have seen some recent coverage on the new accounts, and we want to walk through how they may actually apply to your situation. Just like Mike said, at ACM, we believe these accounts are a great long-term multi-generational savings tool. Created under the One Big Beautiful Bill Act in the summer of 2025, these accounts were launched on July 4th of this year, and they're really designed to help children build wealth starting from birth. Big thing to think about here is the first 18 years, or until the child turns 18, no withdrawals are permitted from these accounts. And they're under the parent's control. This is known as what's called quotations of the growth period. Once the child reaches 18, the account converts to an IRA and the control fully shifts to that child. At that point, they can either take withdrawals, which could be subject to taxes and potential penalties, or leave the funds invested for retirement. Investment options for these new Trump accounts are limited to low-cost U.S. equity funds. The default fund is there bolded in SPYM, which has an extremely low cost of just 2 basis points or 0.02%. All future variations you see up there are legally capped at no more than 10 basis points or 0.10%. Next up, contribution limits, right? Who can contribute, how much you can contribute. There are a few different ways that money can get into this account during that growth period until the kid is 18. First off, there will be a $1,000 seed contribution from the federal government for those children born between 2025 to 2028. As a reminder, any child can have one of these accounts, but only those born within these years are eligible for the free $1,000. Secondly, and the biggest amount are going to be the individual contributions. These can come from parents, grandparents, and others. The contribution limit is $5,000 per year and will increase starting next year in 2027. As a reminder, the seed contribution of $1,000 from the government does not impact this $5,000 annual limit. Thirdly, the employers can also contribute to these new 530A accounts for the child of an employee. This limit is capped at $2,500 annually, and that $2,500 is excluded from the employees, which in this case would be the parent's taxable income, and it is deductible for the business as an employment benefit. Lastly, there are some major charitable contributions supporting these accounts. You guys may have heard of Michael and Susan Dell Foundation pledged 6.25 billion to fund deposits for 25 million children in specific zip codes. Closer to home here in Boise, Micron did announce a 250 million investment for children in their operating areas. Big thing to know about these charitable contributions, if the child does get one, that it does not count towards that $5,000 annual limit. Now I'll pass it on to Scott, where he will discuss more about the management of the 530 accounts and planning considerations to look out for.
All right, how do we open and manage these accounts? First thing you should know, these accounts are self-managed, which means that we can't actually open or manage them for our clients. Similar to how we may have worked with you on your 529 plans, we're more than happy to help you through the process and help you figure out where these accounts might actually fit into your family's plan. Step number one in opening the account is to confirm that the child is in fact eligible for an account to be opened on their behalf. Only one account can be opened per child, and they should not have reached the year that they will turn 18. You also need to make sure that you're eligible to open the account for the child. Only their legal guardian can open the account, which means that grandparents who aren't legal guardians should not open these accounts. If you're in this situation and you want to contribute to one of these accounts for your grandkids, have the conversation with the parents first, let them open the account, and then you can contribute to it. To open, go to trumpaccounts.gov, and you're going to follow the steps to download the app and file Form 4547. This form is what establishes the account. And for eligible children, which, as a reminder, are those born between 2025 and 2028, you have to make the election to accept the $1,000 seed contribution. Once that Form 4547 is filed to establish the account, you'll now be able to activate it at trumpaccount.com or through the app, whichever your preference is. And if you'll notice, this is similar, but it is actually a different link than the one you used before to file the form. It might take a few days after the form is filed for the system to allow you to activate the account. Once the account's fully set up, you can make contributions and your investment selections through the app or the website. I do want to point out that the feedback we've had from clients who have gone through this is that they've made it really fairly easy to follow. All right, so we know what they are, how to set them up, and your next question might be, where might this fit into my financial plan? And here's a few things that we think about when it comes to planning for these accounts. Number one, take the free money. If you have a child who's eligible for the $1,000 seed contribution, you should take the free money and give your child a head start on their future. You should also remember these are essentially starter retirement accounts. Any contributions should be made with the goal of helping the next generation get a head start on saving for their future in retirement, and with the understanding that since these are retirement accounts and they do receive tax deferred growth, they also come with withdrawal restrictions. As Taj mentioned a minute ago, withdrawals are not allowed before the child's 18. And once they turn 18, the account becomes an IRA. And at that point, withdrawals are going to be subject to tax and penalties before 59.5. So if your goal for this money is for it to be used for any shorter term needs, whether that be college, first home, maybe starting a business, there might actually be better ways to save toward those specific goals. Now, for the person who is interested in building multi-generational wealth, there is a super interesting planning opportunity with these accounts. Since these accounts become IRAs at age 18, that means you can also convert them to a Roth IRA at age 18. If you think about it, a young person that's just getting started in their careers is likely going to be in the lowest tax bracket they'll ever be in. So there's a great opportunity to convert this account over to a Roth IRA at really low tax rates, and then just sit back and watch the money compound tax-free for the next 60 to 70 years. Johan, let's take a look at what this strategy might look like over such a long time horizon.
Yeah, of course, Scott. So putting some numbers behind this, this chart, first of all, is hypothetical. It's not tracking any real account, but it highlights the potential impact contributions to a 530A account can have on a child's future retirements. Getting into the chart details, this chart is assuming $1,000 in seed money at birth, plus $5,000 a year in contributions through age 17, growing at a hypothetical 9% annual return. At age 18, the account is converted to a Roth IRA, which triggers a tax bill, in this example, around $32,000. From there, the full balance keeps compounding tax-free. By age 59 and a half, the child's Roth IRA grows to about $8.2 million. To be clear, this is a hypothetical growth rate meant to show the power of starting at birth, not a projection or a guarantee, but it makes the point that consistent early contributions, time in the market, plus that Roth conversion can have a meaningful impact on a child's retirement needs. So how does a 530A actually stack up against the tools previously available? The UTMA, a brokerage account for minors, and the 529. Before we dive in, one important piece of framing. A 530A isn't an either-or decision. It's an additional planning tool for what you're already doing. Opening one doesn't mean you can't also fund an UTMA or a 529. With that in mind, let's walk through the 4 differences that matter most when you're deciding how to prioritize. First, contribution limits. A 530A account caps you at $5,000 a year, combined across everyone who contributes. UTMA and 529 accounts don't have a federal contribution cap at all. The only thing that comes into play is the annual gift tax exclusion, $19,000 per giver in 2026, so $38,000 for a married couple. And 529s even let you front load 5 years of gifting at once. So if a family wants to move real money quickly, a 529 or UTMA gives them far more room. Second, how the money grows. A 530A account grows tax deferred, similar to a traditional IRA, with distributions taxed as ordinary income. An UTMA is a taxable account. Gains in an UTMA are taxed at capital gains rates. 529s have the opportunity to be the most tax advantageous. Growth is completely tax-free as long as it's used for qualified education expenses. Third, who controls the account? A 530A account hands the keys to the child at 18. It becomes their own IRA. An UTMA works similarly. It transfers outright to the child, typically between 18 and 21, depending on the state. If you're worried about a young adult getting full access to a large account, that's a real consideration. A 529 is different. The account owner, usually mom, dad, or grandparent, keeps permanent control. The child never takes it over, which a lot of families like. And finally, what's each one actually built for? Think of the 530A account as a head start on retirement savings, started the day a child is born. Think of the UTMA as the flexible option. It can be used for anything, a car, a first apartment, or a business. And the 529 remains the purpose-built tool for education costs. So 3 accounts, 3 different jobs. A 530A account for an early start on retirement savings, an UTMA for flexibility, and a 529 for education. As we said at the start, this isn't about picking just one. It's about understanding which goal each dollar is working toward and layering these tools together where it makes sense for your family. If you have any questions about how a 530A might fit into your own plan, please reach out to your advisor. We're happy to walk you through the numbers with you directly.
So Johan, we actually did receive a good question here in the chat. They want to know, how do these 530A accounts differ from a minor IRA?
Yeah, at a high level, the major difference is a minor IRA for contributions, it requires the child to have earned income. In contrast, a 530A account lets families start investing from birth because no earned income is required. Since many children don't begin earning income until their teenage years, those additional years of compounding in a 530A account can make a meaningful difference compared with waiting until they're eligible to contribute in a minor IRA.
Johan, I said at the beginning, I love how these accounts can be used for really intentional multi-generational planning. So thanks for the excellent overview. Just wanted to remind folks, we had one great question. If you've got a question, please feel free to use the chat box at the bottom to ask questions at any point. Well, Trevor, we've had a great start to the year in global equities. So why don't you get us started and give us an update on where we finished the first half?
Yeah, I would love to. If you've had your review with us during the first half of the year, it probably won't come as a surprise that the biggest driver of performance has by far been emerging market equities, which are up nearly 24% in the first half of the year. Similar to what we saw in the US a few years ago when the Mag 7 drove a significant portion of US market returns. a relatively small group of companies is currently driving much of the performance in emerging markets as well. When we really unpack where those returns are coming from, much of the story comes down to South Korea and Taiwan and the role that companies such as Samsung, SK Hynix, and TSMC are playing in the development of AI. That's not to say our other asset classes have had a bad first half of the year, because as you can see, international and US equity have had great returns, and global real estate has even outperformed US equities.
Trevor, I notice on the far left there, that bond performance has been roughly flat year to date. We'll come back to the headwinds that the bond market has faced here in just a minute, but let's keep going on global equities and take a look at the last 12 months.
Yeah. Actually, before we do that, I'd like to get some input from the audience and take a quick poll. If everyone could please use their chat box to give their best guess of what you think emerging market returns were over the last 12 months. And I'll give a few seconds or a minute for everyone to reply here.
So this is showing the returns over the last 6 months. You're looking for the last 1 year performance.
Yeah, that's correct.
Oh, we got some good guesses, Trev.
Looks like a couple are coming in here. I'd like to see a few more if possible. Okay, for the big reveal here, as you can see, the great performance we've seen from emerging markets is really just a continuation from 2025, as they're up over 43% over the last 12 months and really almost doubled the return we saw in US equities. What you'll also see is that every asset class you own is substantially higher than their long-term historical averages.
Trevor, as we shift out to the 3 year period, I think the biggest surprise in the data here is that with the truly exceptional performance of US equities over the last 3 years, that's going to be the green bar on the far right, compounding at just a little over 20% a year for the last 3 years. Surprisingly, emerging market equities have actually outperformed US equities by about 2.5 percentage points a year over the last 3 years. If you're a consumer of US media, nobody is talking or writing about this. All we consume as US investors is information on the US market. But rest assured, the global diversification in our clients' portfolios has been your friend. Finally, let's look at the 10-year period. If we look at the 10-year period, international and emerging markets have delivered their historic average returns over the last decade of right at 10% a year. The real outlier over the last decade is US equities, having delivered a 50% annualized premium to their long-term average of 10%.
You know, Mike, the other thing that actually stands out to me when looking at the 10-year data is just the return of bonds or fixed income being about 1.5% and comparing that to what we see in the 1 and the 3 year time periods.
Yeah, this is really the result of the substantially rising interest rates since 2020, right? When we look at that difference, you can see that over the last 3 years, we've really benefited from that rise in interest rates while we've been clipping the coupons as over the last 3 year period after interest rates rose. In that time period between the 3 and 10 year, that's when we had those rising interest rates. And remember, Trevor, when interest rates go up, bond prices go down. And that creates that headwind over that 7 to 10 year period. Trevor, a regular question we're getting from clients is how global equity performance has been so strong over the last year in light of all the geopolitical conflict and uncertainty.
Yeah. I mean, it's a great question because, like you said, every single day we're reading new news about what's going on geopolitically, whether that be the conflict in the Middle East or what we're seeing with the Russian-Ukraine war. Yet we just told you that minus bonds, every asset class you own is up nearly double digits on the year. At the end of the day, it's really simple. Stock prices are driven by corporate profits, and because of this, equity markets are agnostic to geopolitical events. What we're looking at here is the earnings per share or profits of companies within the S&P 500 over the years. Mike and I actually just saw this same data recently updated, and it actually increased since this chart was created. The updated numbers show that there was expected to be a 31% increase in earnings year over year from 2025. If we look at this going back 5 years to 2021, there is a roughly 62% increase in earnings. Like I mentioned, stock prices are directly correlated with company profits, and this is the reason we continue to see great returns, even with all the geopolitical uncertainty.
So I guess the logical question then has to be that if the inflation we're seeing being caused by the geopolitical conflict and uncertainty hasn't shown up in corporate profits, then where do we see it? And that's in the bond market. So what I'm showing you here is what we call the yield curve. And this is as of January 1st of this year. So the beginning of this year, and this is just plotting the yield for treasury bills. So US T-bills ranging from 1-month T-bills on the far left to 30-year T-bills on the far right, meaning bonds that don't mature for 30 years. Then what we show is, if we move this slide, we'll see the red line shows the yield curve as of last week, right? And you'll see that we've had substantial rise in interest rates this year. And that is the market really pricing in that higher expected inflation caused by many of the geopolitical risks in the Middle East. So if we look at the 2-year bond right there in the middle as an example, the yield on the 2-year bond has increased by 0.8% in just the last 7 months. Now, while that may not sound like a lot, being less than 1 percentage point, that's actually a 23% increase in yields in just a 7-month period of time. Then if we go out further to the right and we look at the 10-year bond, we see a 0.5% increase in yields over the last 7 months, right? And again, Trevor, this is just the market pricing in the expectations of higher inflation caused by rising prices around the world. So Trevor, with that, our focus for the past 25 years here at Aspen has been on minimizing taxes and fees to minimize the friction between our clients' gross return and their net returns. You've got some great information on how a few of the funds that we use are lowering their expense ratios.
Yeah, we like to say it's not about what you make, it's what you keep at the end of the day. And one of the factors that drive this is the expense ratios in the funds that you own. We're happy to share that several of the funds we use are reducing their expense ratios by anywhere from 6 to 13%. The reductions may not look significant at first, but they add to several fee reductions made in prior years. And over time, keeping more of your money invested and allowing those savings to compound can have a meaningful impact. And all of the funds that you're seeing there are funds that would be within our client portfolios.
That's great news. Trevor, just to maybe put a bow on this section and summarize things with a few points, there's a few things that I think people should take away from this. We shared a lot of different data with them, but I think the first point that I'd hope people take away is that global diversification is your friend. The world is full of great companies doing innovative work, and we own them.
And lastly, just zoom out and keep a global perspective. Just as we've highlighted earlier, there's a lot of companies across the globe doing groundbreaking things.
Yeah, the final thing I might add is we've had lots of questions from people just uncertain about how their portfolio's performing so well given the geopolitical uncertainty. And I think you did a great job of summarizing. Rising corporate profits are driving equity market returns in the short term, just like they always have in the long term. The geopolitical uncertainty is impacting interest rates and bond prices. So it's happening in the market. The market is accounting for this geopolitical uncertainty. It just may not be where everyone's looking.
Yeah.
Well, Livia, IPOs are certainly a hot topic, and we've got some great research and a well thought out process for how we recommend people handle IPOs.
Thank you, Mike. You're right. The IPO topic has been a hot one lately. We've had several clients ask about IPO investing over the last several months. So Mike Keller and I thought this would be a great time to walk through the details as to why we don't advise that people buy the hot IPOs right away. Some historical context before we dive into the details. In the 90s, IPOs were a regular thing, and at times there were 400 to over 600 IPOs in a given year in the US. But since 2001, we haven't come close to that level, and most years since have been well under 200. From 2022 through 2025, those years had some of the lowest IPO counts in that 35-year window, even lower than the aftermath of the dot-com crash in the early 2000s. So when we talk about IPO valuations and risk today, it's worth remembering that this is happening against a backdrop where very few companies are actually going public, and the smaller pool means more concentrated attention, more hype, and more speculation. All of this excitement carries significant cost. So, Mike, how would you guide someone wanting to discern hype from value?
Livia, it's a great question, and that cost you mentioned is exactly what this data captures. This is looking at IPOs from January 2005 through December 2024, so a full 20-year window with lots of market cycles, lots of different sectors, and it's comparing them against the Russell 3000, which is a proxy for the broad US stock market. Let's start with the left side, price to book. Price to book is comparing what you're paying for a share of stock to the actual net asset value of the company sitting on its balance sheet. The most basic level, it tells you if something is cheap or expensive. And the number of IPOs here is striking at 6.15. That means on average, investors are paying over 6 times the book value of these companies.
Now compare that to the Russell 3000, which comes in at 2.7. That is more than double. And to be clear, this isn't cherry-picked years or a handful of hot IPOs. This is the average across 2 decades of IPO activity.
Which tells you something bigger is going on. It's not just that occasionally a company goes public at a rich valuation. It's that IPOs as a category systematically price in a lot of optimism.
That's a good way to put it, and it makes sense when you think about the mechanics of an IPO. The company and its bankers control the timing, which means they are financially incentivized to pick a window when investor sentiment is strong, there's a good growth story to tell, and at a time when the market wants what they're selling.
Right. And nobody goes public when their story is we're a mature, slow-growing business. You go public when you can tell an exciting story about where the company is headed.
Exactly. So the price to book multiple is a great metric because it tells you how much future growth is already baked into the price before you can even buy the stock.
Which is a different conversation than most people expect to have about IPOs. It's usually, should I try to get in on this hot new IPO? And this data is really asking, what are you actually paying for? And is there room for anything to go right beyond what's already assumed?
And that leads right into the data on the right hand side of the slide, showing the percentage of IPOs with negative earnings, which is 60.26%. That means roughly 6 out of every 10 companies that went public over this 20-year period were not profitable at the time of going public. So if you compare that to the Russell 3000 showing 22.35%, or roughly 2 out of every 10 companies not being profitable.
So among the broad market, which does include some unprofitable companies, to be fair, you're looking at about 1 in 5 or 6. Among IPOs, it's about 3 in 5. So to be fair, again, some of the most successful companies of the last 20 years went public exactly like this. Amazon famously ran unprofitable for years. The point is not an unprofitable IPO as a red flag in isolation, rather that the data tells us that as a category, IPOs ask you to underwrite a lot of uncertainty at a premium price. This is at the heart of why we think about IPO exposure carefully in client portfolios. SpaceX gives us a real-time example of what speculation looks like at maximum levels. The price to book for SpaceX as of June 30th of 26 was 65.11. So a 65 multiple despite 8.7 billion in net loss. And for the kind of long-term goals-based planning we do with families, That's an important distinction. We're not trying to pick the next breakout stock. We're trying to build a portfolio that reflects a level of risk you're comfortable with, informed by what the data tells us about how these stocks perform as a group. It's less about timing the next big IPO and more about knowing what you're actually holding and why. Let's shift from valuation to actual performance. Here are the largest, most high-profile IPOs over the last decade or so. Names like Facebook, Visa, Uber, Airbnb, just to name a few. This shows a 6-month return and the 12-month return following the IPO, compared side by side against the Russell 3000 index over that same window, with a column showing the difference. Even among the biggest, most anticipated IPOs, the results are inconsistent. A lot underperform, sometimes significantly.
And the bottom of this table shows that 90% of the IPOs on this list underperformed the Russell 3000 benchmark after 6 months, and still 78% were underperforming after 12 months. The median return of negative 33% across the list tells us that even among this basket of marquee names, how often and to what extent the IPO returns were negative in the first year. So size and name recognition at IPO doesn't protect you from volatility, and it doesn't guarantee you'll beat the market in the first year. Of course, there will be the occasional outlier, but you put the odds of success in your favor when you use data to drive decisions.
Which loops back nicely to the price to book and negative earnings data we saw earlier. High valuations plus unproven profitability plus a turbulent first year or two of returns. That's the full picture we want clients to have before they think about IPO exposure.
Now, there's a common misconception that once a company gets added to a major index like the Russell 3000, returns will immediately be positive and the path will be paved with gold from that point forward.
The data says otherwise. Looking at returns around index inclusion, the Russell 3000 index itself returned 0.90% over the period studied, while IPOs specifically, post-addition to the index, averaged a return of negative 0.75%. So being added to a major index, something that sounds like a milestone, didn't translate into positive performance for these IPO stocks.
And Mike, I think SpaceX is a perfect example of why our advice is to wait, because the market needs time to find its price equilibrium, and we're watching that play out in real time. So this is a chart that tracks the IPO, the SpaceX IPO since its IPO date of June 12th. You'll see price on the left-hand side, and you'll see the count in days on the bottom through market close on July 28th. The SpaceX stocks is represented by that blue mountain graph. And then just for some comparison, you've got the Russell 3000 index there tracking on that orange line that goes through the middle. So listen, SpaceX is an incredibly innovative company that's achieved unbelievable things in the aerospace industry as well as financial markets. I mean, it went public at historic price. The stock was fast-tracked into several major indices. It was categorized as a mega cap growth stock and is ranked as roughly the 6th largest American company by market value. So the company may be unique, but the stock pattern is the same as its IPO predecessors, and the market just hasn't finished digesting the story. As of market close yesterday, the stock was trading well below its high and its opening price. Trading is based on roughly 600 to 900 million shares, which is only 4% of the stock. Now, if you fast forward to August, the first lockup period expires and up to 20% of shares can be sold. Here's an interesting data point. If another 911.5 million additional shares are released into the market this year at prices of $113 to $115 a share, that's approximately 104 to 116 billion of stock value the market will need to absorb before supply and demand even begin to find balance. And that doesn't include Elon Musk's shares that could unlock in June 2027. So this could mean a supply shock for investors in the short term.
So what does that mean? It means be patient if you want profits. This is still a supply and demand story, not if, but when, and SpaceX is supporting what the research says.
So I mentioned that we have several curious clients asking about accessing the SpaceX IPO, but we also had several clients worried that their portfolios would see a negative impact by being forced to own SpaceX once it was public. Mike, how do the funds we own and use eventually incorporate the new public companies?
That's a great question, Livia. On the left side is a summary of the eligibility and weighting decisions that go into how certain funds and strategies we use are constructed. Eligible markets are US focused here. Security selection covers all market caps down to 10 million, but within small caps specifically, the approach excludes stocks that combine low profitability with high relative prices, which notice is almost the exact profile we just described for the average IPO.
So I think a specific point worth noting is that IPOs are excluded from the funds we use for up to 1 year after they go public, because that first year is exactly when valuations tend to be richest and the volatility tends to be the highest. So this exclusion rule alone is estimated to have increased returns by roughly 15 basis points.
And there's still exposure to mega cap stocks in the portfolio. This isn't about avoiding larger successful companies. It's just that they're held at lower weights than you'd see in a standard index because of that ranking and screening process. And the ranking system is the real engine here. If a stock doesn't meet the standards on profitability and relative valuation, it ends up underweighted or excluded from the fund entirely, which is an important nuance. This isn't a blanket no IPOs ever rule. The stock could still be excluded well after that 1 year window has passed if it simply doesn't meet the profitability and valuation criteria on an ongoing basis. And that's really the thread running through the advice we're providing today, which is that we don't recommend buying IPOs at a high level. The data is clear across a wide industry view, as well as the real-time example SpaceX is demonstrating. Everything we've shared with our clients prior to the IPO is in fact playing out. That being said, if an IPO is important to a client for other reasons, we can absolutely work it into their plan thoughtfully and deliberately rather than as a standalone bet. But again, there's data-driven ways to do that to eventually incorporate the new public companies.
This discussion, Mike, reminds me of a mantra I use a lot with my kids when it comes to certain things. I'm not saying this is a no forever, but a no for now. Let's check in to see if there are any questions that we can address. All right, so our commitment to excellence hasn't gone unnoticed either. And that brings us to some exciting company updates we want to share. So I'm joined by Rachel Lisney to talk about an Aspen Capital Management update. She is our Director of Operations and Chief Compliance Officer.
Thanks, Livia. To start, I'd like to extend a big congratulations to our advisor, Scott Warner, who you heard from earlier, for passing the Certified Financial Planner exam earlier this month. Scott is already an enrolled agent, which means he's a federally licensed tax practitioner. The CFP is the gold standard of our industry, and Scott studied diligently over the last year to prepare for the exam. With 3 young kids at home and a full plate at the office, this is especially impressive, but not surprising from Scott. So congrats again, Scott. To give you an update of where our clients are located, you can see that we currently serve clients located in 34 different states. We are blessed to have the opportunity to know so many of you located in different areas, including friends and family members you've referred to us over the years. Since our last update in our February webinar, we have not made any progress in the states directly west of the Mississippi River. So if you know anyone in those places who could benefit from our services, we would appreciate an introduction. Livia, would you like to continue with our updates?
Yes. Our team of 12 is serving 330 families and managing 1.5 billion in assets, but the numbers aren't really the point. They're evidence of something deeper, which is families are trusting us with what matters most to them at every stage of their life. So far this year, we've welcomed 23 new clients across 10 states, literally from Hawaii to Florida. Roughly half are here in Idaho and half are from out of state. Our new clients are a lot like our longer term clients. They are business owners, people getting ready to retire, some who have already retired, and young professionals building wealth. Different life stages, different zip codes, but the need is the same. They all want trusted advice that's in their best interest, delivered with real care and at the highest standard of excellence. So this is exactly why we do the work that we do, and it's resonating. 74% of our growth in 2026 has come from introductions from our wonderful clients like you and the amazing professional partners we work alongside. People are experiencing real confidence and problem solving, and they want the people they love to benefit in the same way. So if anyone comes to mind, someone who could benefit from the work we do, please reach out to your advisor and we'll help you decide the best way to make an introduction. Aspen Capital Management continues to get noticed by our industry peers for having a culture of excellence. We were recognized by Worth Magazine and Newsweek earlier this year. These are both national publications that evaluate and rank advisory firms using regulatory filings and other objective data. And this year we've been recognized a little closer to home. Aspen Capital Management was named one of Idaho's fastest growing companies through the Peak 43 Award. Peak 43 is put on by Boise Dev, a local online news outlet here in the Treasure Valley. They'll be publishing the full finalist list on August 6th, so we wanted to give you all a bit of a sneak peek before this goes public. The national recognition is wonderful, but it means something different to be recognized right here in our own community. So thank you for being on this journey with us, and we are grateful for your trust and support.
Thank you, Livia and Rachel. Before we wrap up, I just wanted to say a huge thank you to our team. You don't receive these type of awards or earn the trust of clients who regularly refer us to their friends and family without having a team of people who come to work every day with a focus on acting in our clients' best interests. So thank you very much to our team. I want to echo, Livia, your comment. If anyone has any questions coming out of the webinar today, please feel free to follow up directly with your advisor, and we'll be happy to spend some time with you.